All right, super. Let's go. So, welcome again to another Centaura webinar. Today is the first time that we actually gonna do this with two panelists. So, I invited today to join me my co-founder and CEO of Centaura, Anthony DeMartino, and we're gonna be chatting about all the things related to Project Firelight that has become really hot. And there is a lot of community questions, so we just wanted to have a fireside chat about it. And because we're closing the year, we really haven't had time to plan anything. So everything that you're gonna see here is completely organic, and it's just Anthony and I talk about Firelight every single day. So this is more like just another conversation. As you guys know, we start these webinars every time just giving an update about Centaura and in the last 3 weeks. So there are a few things as we're closing the year. There are things that are worth highlighting. So just a few months ago, we decided to launch our first DeFi bots in protocol side, Euler and Camino, and more recently Morpho. And it's something that we never done before. And just in a few weeks, this week, we effectively became the biggest bot in Euler and the biggest stable bot in Camino. So the progress there has been remarkable. And earlier today, we launched our first bot in Morpho. So you Morpho, so you're gonna see some of that. Also, there was a BTC bot that we launched with Lombard that is probably going to be fully announced early next year, but it's live and it's taking deposits and producing yield in BTC. On the risk radar side, we had 3 releases related to Aave. So if you go to our risk radar product, you're going to see the Aave Horizon Risk Radar. Their RWA platform has over 20 risk signals for Aave Horizon, and the same for Aave Plasma, and the same for Aave Inc. that is called Tidro. Also, about 3 weeks ago, Kraken made public the news of their debit card announcement. It's called Crack, but as part of that announcement, they disclosed that they were working with Centaura as their geo provider for the Kraken Earn product. So going to go into production next year, and we're very proud to be working with Kraken on this. Also, on more related to what we're gonna talk about it today, we launched the pre-deposit bots for Firelight, and we were pleasantly surprised that we hit the caps within 6 hours, the first 54 million, and it was 100% retail capital. We didn't have a single TVL deal. We didn't have a single institutional deposit. Was over 3,000 deposits, the biggest one. There were only 5 over 1 million. So we were extremely surprised that of the support by the community, and we were very proud of it. And then now the question is, when are we gonna do Cap 2? So these are some of the updates of the last 3 weeks. We're closing the year, so the next webinar in 2026, you're gonna have a full recap of Centaura in 2025. So with that, I would like to go through the webinar. But Anthony, I'm gonna start like most people in this audience are not familiar. This is your first Centaura webinar, so why don't you spend 2 minutes just introducing yourself and
Sure.
drive it all the way to Firelight.
Cool. Thanks, Jesus. Anthony DiMartino, CEO and co-founder of Centaura. I've been in the digital asset space for 4 years when I started Coinbase Risk Strategies, which was a DeFi and derivative trading desk within Coinbase. That was in 2021, January 2021. That's where I, funny enough, met Jesus when he was running into the block. After one meeting with Jesus and understanding their Smart Yields product, I became a client within a month and ran almost all of our DeFi strategies through into the block. Uh, Previously, I spent 22 years on Wall Street between UBS, Barclays, HSBC, always on the trading side. So I ran short-term interest rate trading at UBS, and then I ran the Fannie Freddie trading book before the housing crisis. I moved to Barclays, where I became the global head of EM and EM rates and FX trading, and then HSBC to run all of LATAM local markets and banks. That's it.
So let's start with Firelight. Like, how did we arrive to Firelight? Why do you think like we obviously are both passionate about this topic of insurance and DeFi? Like, why is it important? Why does it matter? And what is if you play counterfactual, what happens if we don't have insurance in this space?
Yeah, I mean, I give you a lot of credit for this. So pushing on this insurance narrative, but I think where the thought process struggled is how do we insurance is not something that you can do at a small scale to be significant, but how do you not only bring in enough capital to it to scale, but also make it economically viable for the buyer and the seller? So, we've done a ton of work on how to price the risk because, Into the Block has been running risk management and managed capital at scale for years um, with a perfect record. So you obviously know how to run and risk manage capital. And then we kind of went into that long weekend when we decided let's break this all down into the individual risks and see if we can price it. When we came out of that experiment, we're like, wow, we can price it. We think it's economical, but now we need to find the capital. And it was funny because we were discussing credit and insurance pricing on one side, and then Firelight was kind of happening on the other side. Um, and then I don't know what the aha moment between the two of us was like, wait a minute, XRP collateral on Flare pays nothing. XRP collateral pays nothing anywhere. What if we could give yield to XRP holders who have a systemically important asset, large market cap, tons of liquidity, but very little utility. So being able to unlock the demand of XRP holders to basically provide the capital to the insurance business was kind of, the big unlock for us.
So this is a problem that has been tackled before since the beginning. Ideally, you want insurance and the capital markets to evolve closely together. But all the attempts were we call it using DeFi to insure DeFi. That like, why doesn't that work and why doesn't it scale?
Well, I think a couple of things to bring up. One, the intention of Firelight is not to ensure people who are already comfortable with the risk they're taking in DeFi. What the intention of Firelight is to bring on the next 300 billion of TVL into crypto, who we see as the main gating factor. Now that the political headwinds have changed, the regulatory headwinds have changed, there's clearly demand from traditional, may them albeit more payments and fintechs than banks to be in this space either through stablecoins or DeFi. I think the last big hurdle is smart contract risk, which is hard for them to understand or define. Uh, and I think at an oversimplified version of Firelight is Firelight converts smart contract risk into collateralization risk, which these players understand. So we think for that reason, this will be a big unlock to bring in new capital into DeFi that requires this insurance. So think about if PayPal decided to offer, earn with PYUSD in your Venmo account fully insured by Firelight. Think of Revolut offering this to their clients. Think of Coinbase and Kraken debit cards offering, hey, while your cash is sitting on platform, earn collateralized and above treasury yield. This is what we're building Firelight for. We're not building it for the existing degens, but there will be a transition period where we start with existing DeFi risks to insure and then evolving that. The other thing too, to make it clear to everyone, there's not a price for every risk. We're setting a bar at a super safe, risk managed, and well thought out place. So we'll set a bar of what's insurable. Everything won't be insurable. Not every asset, not every protocol, not every pool within a protocol. the risk is very granular that we go down. I think we have 75 to 80 risk metrics for each protocol that we decomposed. But again, I guess it was a long-winded way of saying Firelight is to bring DeFi to the future, not solve the issues that we've had in the past.
But why couldn't I do it before, just launch a protocol, take Ether deposit, and go insure Aave
I think,
with the.
yeah, I think that was what was attempted by prior kind of trailblazers who started insurance. And, I think we're just building off of the success that they've had. I think the issue with scaling is using ETH to insure ETH on a protocol like Aave, right? There's the commercial viability doesn't make a lot of sense, especially when you could just deploy the ETH yourself onto Aave, right? So there's really you're not really insuring anything at a rate that makes sense than just doing it yourself, right? And so this is a big component of Firelight where we're taking assets that have, in theory, a zero cost of capital to ensure and zero DeFi correlation to ensure a higher cost of capital and highly correlated risks and assets. So I think that's probably the big differentiator. The other is understanding the insurance. So the existing insurance is one-to-one. So somebody posts $10 and they insure $10 of smart contract risk. Traditional insurance is built on diversification, which leads to leverage, right? Diversification that leads to leverage. So what that means is you grow the pot of things you're insuring, and if those risks are not directly correlated, you get to this concept of diversification. So if we insure different pools within different protocols, different Oracle risks, different bridging risks, some custodial components, and you build that into a diversified book of business, you can then leverage the capital that you're using to insure those risks. Typical leverage models in regular insurance, real world insurance like life insurance, is about 7 to 8 times the premium that they take in. So basically, what it's saying is no insurance company on earth has enough money if everyone dies on the same day. So they don't price it that way. They create diversification within different patterns to ensure that they always have enough capital for an expected loss and an expected recovery. And that's how we've modeled Firelight, which is very different than the existing structures. It makes it more economical for the buyer. It makes it attractive for the supplier. And it also models it in such a case that the risks are very apparent and minimized, and that there's enough capital to cover the worst case scenarios.
Yeah, so two of the things that at least were very hard for me to deal with when building Farlight. One is you never want to work on a problem that needs a scale to begin with, because that's really hard to solve. And the thing is that for whatever reason, the previous attempt, not for whatever reason, for several reasons, the previous attempt to solve this problem didn't work. And now there is a massive gap between where DeFi is at and where DeFi insurance is at. Which means that you need to start with billions to even have a chance of succeeding at this. And we just struggle with this for a long time. And then uh, I think you came up with the idea, well, we need to look at uncorrelated DeFi assets and XRP, XLM, even Bitcoin. And uh, that is a massive unlock. The other one is what you alluded to, that this is for the next unlock. So I looked at it almost in a spectrum, like the existing DeFi demographic that deploys in protocol probably doesn't care about insurance. Then you have firms like us, like Centaura, we do care a little bit because we manage risk, so insurance is a price of risk. Then you have exchanges and wallets, and they care even a little bit more because they now they're integrated in DeFi. And then it's what comes next. And then you have fintechs, Revolut, Robinhoods of the world. They definitely care. And then you have banks and asset managers. And then the question is, if insurance doesn't exist, is that such a big blocker that those guys would never adopt DeFi, or is something that they will get around?
I, I hate to say never, but my 22 years working at a bank, we definitely took on risks that are much larger and much more extreme than, say, smart contract risk. I'll give you an example. When I was head of LATAM for HSBC, we went through a failed auction that led to capital controls in Argentina. When that happened, my clients were PIMCO, BlackRock, Exodus Point, Franklin Templeton, all large EM investors that were invested in Argentina, got absolutely destroyed. Right. I'm talking about 90 to 100% loss on these positions, who were stuck in it during when the capital controls got put in. That type of risk is also, ones would argue, is much larger than what we see in DeFi. That was total loss. Um, but the reason they were able to take that risk and the reason we were able to intermediate transactions in those bonds and that currency was because we had a risk framework. We had an understanding, we could model it, and we could price it. Now, it didn't mean we priced it right, but we did have a framework around it. And we had people who understood the risk that built that framework. The problem for fintechs and banks is they don't have anyone at their organizations to even build the framework, to even think about what that framework should look like, and then staff it with smart contract engineers. If every institution that wanted to do this had to create a team of 3 or 4 smart contract engineers and a risk manager, I mean, I don't even know if we have 30,000 smart contract engineers on the planet. We would need 10 times that if we were going to do that. So I think, could they eventually get there for a select few? Sure. But I think the way to mass adoption is just convert it to a risk they understand, which is collateral against my smart contract risk. That's, to me, the
Yeah,
big
and
opening.
this is important because the obvious counter to Firelight is why isn't a traditional insurance company do this is they're
Same
never going to
reason.
be able to understand it, right? Like how are they going to be able to price it and if you never manage that risk, how can you possibly price it?
Well, what's interesting? While they can't price it initially, if Firelight grows and is successful, it's going to be really attractive for reinsurers to step in, because reinsurers take on a larger basket of risk. So they will buy a portion of life insurance from life
Could
insurer.
you explain that for that this is
Yeah.
something that took me a second to wrap my head around.
So remember when I talked recently earlier on the conversation about diversification? So within a life insurer, they diversify between age groups, smokers, non-smokers, regionality, all different types of factors. Same with auto insurance or property insurance. But then you have these companies called reinsurers who will take a piece of the property insurance business and a piece of the life insurance business and trade insurance and disaster insurance and bring that into a much bigger pool, which is even more diversified. And something like this type of DeFi risk is massively uncorrelated to anything they have in their book. So what that does is as they are able to onboard and step in from the reinsurance side into DeFi risk, the correlation is it's so not correlated that they get an even bigger leverage factor, which then allows them to either lower the costs for the insurance buyers or make more profit. So the end game for this is building the sample portfolio, getting it into the billions. And I think at that point, they'll have a track record, they'll have a risk model, and they'll actually have something to buy, which I think will then engage them in doing the work to step into this space.
So I deviated on this the reinsurance thing because it was interesting. But before we were talking about the risk framework, and I have this, this phrase stuck in my head. So recently, we were talking to investor that we respect a lot in the space, and that is deep into this, and he has this phrase and said like, how can you insure a space in which the losses are infinite? And this is something that we've wrestled because the way we explain this is most of the traditional actuarial theory doesn't apply in DeFi at all. So how do you want to deep dive into how do we think about risk? What are the vectors and how do we went about it? Because when a protocol gets hacked, you lose everything, or most people think you lose everything. So how can we price something like that?
Yeah. Well, I think a lot, well, first phase, I think a lot of the exploits that have happened, because we looked at the whole market of exploits since the beginning of time for DeFi, and trying to look for correlation and causation and looking for patterns. And then when we did our modeling, we included everything that ever happened on every protocol and every asset. So our initial models are extremely conservative because it takes in, uh, I would say, 80% of things that we would never would have seen as insurable. So like once we get into what we call the insurable universe, that risk comes down dramatically. Um, I when we got into the other thing that Jesus alluded to is how do you evaluate recovery and loss when typically when a protocol loses money, they don't exist anymore, right? So you kind of have it's almost like the death certificate, and when someone dies, and there's no more modeling information after that. So we used what's commonly used in all type of prediction models is Monte Carlo scenarios, where we put in as much of what we did know into scenario and have it run a couple hundred scenarios that never happened before, and then shock testing what the outcomes would be. To oversimplify this, insurance is not about, there's the probability of loss. So the probability that a protocol loses $100 million. Um, then there's the probability of loss aggregated across the whole portfolio for a given period of time. And then there's the anticipated recovery. The anticipated recovery is really interesting because what we saw as the recovery value of the whole industry was pretty high. I think it was somewhere around 68 to 70% of any type of exploits. And exploits as compared to the overall TVL of the market, it's actually really low. I think it's a couple percentage points. So you have a very low probability or amount compared to the size of the market, and you have a very high recovery rate when it does happen. And when you dig even deeper to that, you see much higher recoveries of protocol exploits than you do of asset exploits, right? Like, and it's a lot of it's skewed by Terra Luna because USDT was massive and went to zero. But we've seen things like usual in this cycle or stream or elixir where essentially these assets end up going to zero. So the bar to insure individual assets becomes a lot higher. So I think it was kind of a long-winded way to say that, we're taking a very innovative approach. And then the last thing I would say, maybe you could talk about this, Jesus, is how you broke each individual protocol risk into dozens of individual risk vectors, because I think that's really important.
Yeah, by the way, if you guys have questions, use a Q&A panel. So we're gonna answer some in a minute. So a couple of things in this one. So there is a brilliant book that covers a lot on the history of insurance. It's called Against the Gods. So it's really about the probability theory related to risk, but quantifying risk has a long history in mathematics, from Girolamo Cardano playing dice to there is a famous correspondence between Pierre de Fermat and Pascal, Blaise Pascal, playing a game of probability. But the real first case of insurance of attaching a price to this is with the Lloyd's of London, right, in the 1700s. When you look at that, you can see that the it's not different than DeFi. The industry was tiny. Most of the ships were in the few oceans, so there is a big typhoon, and the losses are pretty much infinite on the entire thing. But then it evolved. From there, there wasn't insurance. There wasn't insurance for any other industries. You couldn't diversify. Like, it was the same thing. Now, when it comes mapping this to DeFi, so we think about the problem in four fundamental vectors. There are two big ones and two small ones. So the big ones are technical risk, meaning a hack, and economic risk. And the smaller ones are oracle manipulation and bridge transactions. By far, so economic risk is what we do at Centaura. We have over 1,000 risk models. We have been protecting billions in capitals for years, so we know how to do this. The technical risk is a very difficult one to get your head around, because when a protocol gets hacked, you know, theoretically you could have infinite losses. And then how do you quantify something like our Uniswap that never been hacked? How can you extrapolate a risk model for that? So the fact that another lending protocol was hacked is not a proxy. So what we did, and is far from perfect and it's evolving, is we decompose these protocols in an over 80 very, very granular technical vectors. We looked at the analyze entire source code with LLMs, looking at all sorts of invulnerability, modularity, complexity, frequency of changes, things like that. Then look at other hacks that have exploited some of those vectors. And we looked at that in a multidimensional space, judge proximity to those, and then that gave us a series of baseline models Then we run a bunch of Monte Carlo simulations with that, saying what happens if XRP drops from here to there, XLM from here to there. And then that gave us a more refined model. And then we went to the protocols and say, because we work with all these protocols, we said, does this make sense? Is this crazy? And then we got a lot of feedback and iterated, and we're still iterating. So it's I think we have very, very good model coverage so far, but it's far from being perfect. Economic risk again, DPEX, whales, this is what we do. Oracle manipulation, we have a lot of model coverage on that. And bridge transactions is a new one that it came from a partner that we're looking at this in detail. One thing that when we look at these risk vectors, if you put it in a spectrum, and Anthony, I'd love to get your take on this. So there is different things that you can price, right? Like you can have insurance at an asset level, let's say, so Athena, right? And that is interesting. But what we found out is as you get more granular, you start getting more futuristic, right? So you can insure pools in different protocols and combinations. Of those, you can insure an entire protocol. We think in the future you should be able to insure transactions. So you should be able to, I'm gonna bridge, I'm gonna buy a policy, bridge over, and then pay the policy back. But it's interesting that as you start getting more granular, the programmability start getting more interesting, and then you're gonna start doing crazy stuff that you're gonna do
Yeah.
with traditional insurance.
Well, it's not only just that, right? Think about a dollar is perceived to have value and is integrated in the financial ecosystem. Well, XRP has value too. But the problem is it's not integrated, not only in the traditional infrastructure of money, but in DeFi as well. So I think if we are successful, one of the big benefits of Firelight is giving much more value to XRP through the ability to do more things with the currency. So I think that's a really big unlock. Um, I think there was a question here that maybe we should address, Jesus. Do you want to address that right on head on?
Which one?
I'll
There
read
are
the
a
question
bunch.
here. How do
Okay.
I envision an insured protocol? For example, the Aave ROUSD vault. ROUSD is lent out and earns approximately 5%. Can I hedge an individual position? Okay, so the way Firelight's going to work is, remember when I discussed earlier about diversification, the options you're going to have in this current stage, we're in a pre-lockup scenario. When we're targeting the first week of April to actually allow people to move their capital from this kind of pre-lockup scenario to actually earning the real yields of in XRP on Firelight. Now, you don't get to pick and choose what pieces of the diversified pool because we would lose diversification. So if you say you're going to insure this pool but not that pool, what would end up happening is it would go back to the original model of one to one, right? So we can't. This is not how this model works. What you will be able to choose is where in the capital stack you want to be. So we're envisioning a first and second loss. So you can try to earn a higher yield, let's call it 6%, if you were sit in the first 30% bucket, and a lower yield if you want to fit in the bottom 70% bucket. Hopefully that answers your question.
Yeah, by the way, let's typically we wrap this up in 30 minutes, but we're gonna go for another 15 minutes, and I just asked our head of VP of marketing for permission, and he said yes. So it's the first time that we go in one webinar past 45 minutes for 30 minutes in 5 years. So why don't you explain to people what Firelight is actually? How does it work? Like I'm a depositor, like what do I get? How do I get it? How
Yeah.
does it work
So
underneath?
so so the way it's envisioned, and let's assume we fast forward to April, when our goal is to start with a diversified pool of things we're insuring, and that's what we're spending every day from today until April 1st to make sure that we can launch with a diversified pool. So if we just launch with coverage on a single protocol, then we're back to the original problem we talked about of no diversification, so it's one to one. Um, so the idea there is we will be able to the target is to be able to have a full diversified pool. Um, in April, when the locking period ends, like I mentioned, you'll be able to choose if you want to be in a first or second loss, and what the estimated yields will be. And then the idea is that you will be paid in the base token. So you'll get paid in XDXRP for, I would say, 70 to 80% of the yield. And then the other 20 to 30% will come in XFI tokens. And those XFI tokens will actually be bought and not minted. So what does that mean? So we insure a pool that pays 100 grand a month. And so let's say it's an ETH or stables. We'll take 70 grand and buy XRP, STXRP. That'll put buy pressure on XRP. And then we'll take the other 30 grand and buy XFI token, which will be putting buy pressure on XFI token and delivering it to our users. So that's the construct we're envisioning going forward. Now, don't take it as Bible because we have to work out the mechanics of the SFI. We don't want to create a scenario where the buying, because we'll have natural buy pressure because we're getting paid in base assets, puts a disproportional amount of pressure on XFI. We're not here to try to juice the price. We want this to build slowly over time. We're going to price the token, I think, very attractively. We completely disagree with the whole low flow, high FDV nonsense. When the best day for pricing is the first day, we want to incentivize people to stay in for the long haul. So we want to continue to put buy pressure on the token, but we want to make sure we don't create a short squeeze, which would artificially inflate the price. Hopefully that answered the question.
Yeah, so before we go to Q&A, there's a ton of questions. So so if we fast forward and get visionaries and ambitious about this. Somebody told us the other day we're building the first insurance solution in history with zero cost of capital, which is interesting, a good position to be on. What is like a big vision for Firelight? Like how big could it be? Like even beyond DeFi, like what are the things that it could unlock?
I mean, listen, we can get if we get this adoption from fintechs, what we're really riding on is this new neobank narrative where all of these fintechs want to become their own banks, but instead of the traditional banking model where it's fiat and treasury yields, is instead being stable coins and DeFi yields. I mean, it's almost the sky is almost the limit. Um, this also benefits all of DeFi because the users of those applications are not degen. So they're not remembering the times of 20, 30, 40%. They're just happy to beat the Fed funds rate, which is continuing to drop with what the Fed is doing. So, 100 basis points to 200 basis points. So you're basically bringing in a bunch of capital that demands a much lower rate of return if this insurance unlocks that. So if this becomes infrastructure as opposed to a dodgy, scary market for people's assets, the scale of which, and if the neobanking craze actually takes adoption, I don't want to say sky's the limit, but it's a material number, and it's going to drive DeFi to what it was built for, a real use case.
Yeah, I mean, look, for us is we built Centaura to build that institutional layer of DeFi within insurance. We didn't have to do this. We think that we're in a good position to do this. But we didn't have to. This is it's a monumental problem. It's difficult as hell, and therefore the chances of not working are non-trivial. It's probably one of the most ambitious projects we have seen in DeFi in the last 3 years, easily. But if it does work, then it could it could help to legitimize the industry. It's a massive unlock for a next generation of capital. And then you have the interesting thing is you have all these XRP, XLM Bitcoin holders that are not, they don't have a yield option for them. So if they could deposit in Aave, of course they will deposit in Aave and earn 3 to 5%. And Firelight give you the exposure to those protocols without even touching the protocol. So you take the same risk. If Aave gets hacked, you lose your capital, but you're not even in the protocol, and you get a higher yield. So it just seemed like from that standpoint, it could be quite attractive. There is a ton of questions here that let's go through a few. I want to take one that is on the competitors. So somebody asked, how are we different than Nexus Mutual and other competitors? So look at it's very, very different. So I'll give you a few points. So we started the webinar by explaining why none of these attempts, including Nexus, which we like the team, that they have failed to achieve critical mass, and then therefore now there is a massive gap between what they can cover and what the industry needs. So there are major differences. One, we use non-DeFi assets to insure DeFi, right? So we're not taking one ETH to insure another ETH. We have pretty sophisticated models for leverage and things like that, which allows to scale fundamentally faster. We're not targeting retail. So I think this idea of retail is going to buy insurance as a fundamental friction point. We spend a lot of time thinking about this. We're targeting institutions and retail via institutional channels. So you can get insured by depositing a Kraken earn vault, but not because because you're buying insurance directly. And then, if I may say this, we have been managing risk for 5 years, so I'm survived 22, 23. So it's just hard to take an insurance play credibly if you never manage risk. So if you haven't been there, how can you possibly price it? So it's that to me seems a little bit uh, disingenuous in that sense. So I think for whatever it's worth, there are like 3, 4 risk managers that I would trust to probably insure capital in DeFi, and we're one of them, but they're not like 10. So it's there is a lot of there is a lot of similar. Having said that, we might fail tomorrow, so this is a very risky. This
But
is a very difficult problem, and yeah,
so there's one question in here, and it says, "Are you planning on using AI agents for automation or management in
yeah.
any way?" So
I saw that.
I don't know if that's some of the ADM crowd, but I did want to say that for Firelight specifically, if you guys don't know Jesus' background, you should check in AI. He just sold an AI company he incubated to Cisco, so he's definitely not a lightweight in this space. Maybe I'll let Jesus talk about this. We believe we're using AI throughout our whole business, whether it's identifying strategies, identifying risks, simulating risks. We're moving to a world where if you're not thinking about identifying and managing risk using AI, you're missing the script here because eventually this risk space is going to move so fast that individual human beings staring at code is not going to keep up with the pace of change. So we are, I think, at the forefront, and maybe Jesus, you want to give a couple seconds on how we are thinking about using AI and how we're currently using AI to better our risk models.
Yeah, look, in Firelight is going to be one of the first AI first insurance protocols. Sorry, that sounded redundant. So every single model, every single policy cover it has a very strong AI component. The protocol has AI functionalities in terms of taking a request and pricing it correctly. It has AI component in terms of monitoring and managing the risks. So we incorporated AI into all sorts of capabilities. Now, there is another related question here that is where we were actually looking to ensure AI agents too. I think this is related to something I wrote on Twitter. In the past, insurance for AI agents is a very nascent space, but it's one that it seems to have a viable market because agents are non-discrete, right? So they're continuous. So you cannot have for the same input you can have different outputs. So if an agent is doing mission critical stuff, how can you measure that it's using that the outputs are correct and pricing that right hallucinations and all that is important. It's important. There are a couple of companies that have launched with that premise, and we have been talking about if we're sitting on this pile of capital, can we use it for insuring AI agents in the future? So that's another idea. So going through the questions here, somebody asked about the timeline and whether Firelight is launching in April. Just to qualify, we pre-launch, so the Firelight is live, the pre-deposit bot. What is launching in April is our first insurance, the first cover product, right? That to actually transitioning from points to real yield. That timeline is not fixed in my, there is some flexibility there, but we're aiming that. Another question was how quickly are we going to transition from points to real yield? We're trying really, really, really hard to not do the point stuff for years like many other protocols. We're trying to operate in a time frame of a quarter, and keep it that way. So it's in that sense, we should see that transition um, very rapidly. Then let me keep going through the list here. Boom, boom, boom. Net insurance in DeFi, we answered this. Firelight, we answered that. There were some ADM questions and refused to answer those. And then somebody asked, what can you do with the Firelight points right now? We have this is we have been having a ton of debates about that stuff. Anthony,
Yeah,
do you
we're
wanna?
no, we're not. I mean, listen. I think everybody understands the unsaid component of points to tokens, but um, yeah, we can't be that expressive about that. But I think if you looked at other programs, we'll be pretty similar.
Yeah, so another way to think about this is Firelight is an insurance protocol and it's on the highest spectrum of safety. There is you're gonna be able to do things with XCXRP and points in DeFi, but you're not gonna be able to do a whole lot. Like that's not the point. Like if you deploy in Firelight is to ensure Aave, it's not to go speculate somewhere else. Of course, we're gonna have DeFi coverage, and
Yeah.
we're already having some, but there is a line.
So
Um,
can we answer
yeah.
Anshin's question? Because I think it's really good. He said, who will decide how much to pay in case of a protocol hack? So we are it so I would say 99% is going to be programmatic. We're going to be very explicit of what's covered. At a high level, we're not only going to cover smart contract risk, we're also going to be covering economic risk, like depegs, bad debt, Oracle manipulation. So, you know, unlike Nexus Mutual, which rarely pays out because the risks that it covers are quite limited, this is much more expansive. Um, as, so I would say there's going to be roughly 5 to 10% that are going to be in a gray area where a decision has to get made. I also think that even if a decision is straightforward, there should be a council of people that decide. So we're building a council of multiple players in the space that it's really hard I'd love to find 5 players in this council that have no conflict of interest, but honestly, I don't, for how expansive this project is anticipated to be, I think we'll find it difficult to find that profile. So the idea is that we probably I think we're targeting 6 to 7 people. And again, we haven't spoken to anyone specifically, but think of oracles, bridges, exchanges, protocols, curators, um, anyone else we can think about, audit firms, TradFi insurance companies. We want to make this a public good. And to make this a public good, it needs to live free of conflict of interest, and it can't be anti-competitive. So we want this to be a good cross-section of the industry. One, to get better adoption, but two, to make it very transparent and fair of how these things get paid. And that's why, and that's kind of, hopefully that answers your question. But I think 95% programmatically, the gray area will be decided through a council of non-conflicted people. So in theory, let's say we take someone from Chaos Labs and someone from Steakhouse on the board, and it's an Oracle, it's a Oracle manipulation on Aave. Well, obviously, Steakhouse can stay in to vote, but Chaos would have to step out because they'd be conflicted. So the idea is to get to a minimum of three voters, an odd number above one, that are non-conflicted for each incident. But yeah, hopefully that offers question. We're also, again, this is being incubated as a subsidiary of Centaura, and Jesus and I are the interim CEO and CPO, but our goal is by the end of 26 to have this a fully autonomous organization of which we are just a client of. We've made our first hire into Firelight, Connor Sullivan, who's the head of insurance. We'll be also making a bunch of strategic hires directly into Firelight as soon as we close our round, which is scheduled for the end of January. So, but I would love feedback from people on anything you think we can make better. We're going to bombard you with our models. We're going to bombard you with our assumptions on our choices, discussions. So for this to be a public utility, we need is a lot of public feedback. Try to be nice, but everyone's a tough guy on Twitter, but we appreciate any and all feedback that will help make the product better.
So Benedict Holman has a bunch of good questions. One of them is, will protocols looking for coverage have a deductible to be covered under Firelight? Look, the criteria is we're not going to cover everything, right? Like it's another problem with our predecessors. So we're trying to end for the safetier side of DeFi. One intangible criteria that we use is, protocols that Centaura is deploying on. Like obviously that means that we can model the risk. We have a very comprehensive risk process for assessing this in both markets and technical. So if you pass that and we can price it, then we're able to cover whether the protocols package that into users with some deductions and things like that. Yes, by all means. There's some questions here about hardware wallet support. We're working on it. So far, this was integrated into a number of wallets that have support for XRP, and we're working on others. There is questions about the EU geo blocking.
We passed on that question. I
Yeah,
answered it.
yeah, we're trying. We have a new legal counsel. It's pretty tough. Uh,
Ask the EU to have reasonable laws, then scrap MiCA.
yeah. So
The last question is
uh,
absolutely Stellar and Hedera are targets because they fit the same profile as XRP. What I would say is we are in no rush at this point. I think we chose the largest asset, and we have a great partner in Flare. And I don't think we would move to these other chains until all the demand is satiated for XRP users.
yeah. So Sammy here is asking, how can he get access to Firelight? Just go to firelight.finance. Obviously, we hit the first cap. We're gonna be unlocking the second cap in the next few weeks. We're gonna announce the timelines soon. So we're working through some things to verify when is a good timeline for it. There is an interesting question here. So Charles Steele asked, I'm gonna change this question to my benefit. So he said, will Firelight Centaura eventually provide a debit credit card for a stablecoin? So the answer is no, but Anthony, do you want to talk about what we're thinking of, how we have been
Oh,
approached by debit cards?
yeah. Well, I answered that question the opposite way
Yeah.
you did. So,
Yeah.
so yes. So one of the core things that we want to ensure, because we're ensuring the next wave of people coming into the space. We're not here to ensure degens because they already know the risk they're taking and it's a different profile. But neobank offerings like, I would love to ensure a direct deployment of DeFi from a Revolut or a PayPal Venmo app. Debit cards are high on our list, and I think we'll be announcing an LOI with a high-profile fintech debit card issuer in the coming weeks. So yes, a high target for us to offer this type of insurance, right? Because I think it's going to be hard for someone like a PayPal to say, hey, we're going to offer, opt in to earn in DeFi and have their users be completely exposed to DeFi risks. I think it's a complete non-starter, but I think insurance is a complete starter for them.
Yeah. So there is another these questions are really good. So another one that is interesting that you can tackle, that is, do the bolts have an expiration date or are they continuously valid? Which means if I deploy XRP how should users think about how does that get rolled over after a cover
Yeah,
expire? And
I can take that. So we have two really different use cases, it'll be. I'll address one of the points like the double dippers. I'm a little bit I was a little bit taken aback by we're creating real yield for XRP, and then people all they cared about was double dipping on points to deploy into DeFi. Not really the goal here, but mercenaries be mercenaries. Um, when you deploy into the vaults, they'll be running on a currently model is you'll be running on a monthly. You basically be if you do nothing, you'll stay in the pool. About a week before the monthly roll date, you'll be able to indicate whether you want to come in or out, and that'll allow other people to come in. So we're going to really control the amount of capital coming in because we don't want too much capital to come in and dilute the economics. We want to keep that economics around 3 to 5% for the suppliers, and just don't want to be TVL slobs and just take in as much as we can and push the rate down to 1 or 2%. Like, we want it to be economically viable through multiple cycles. The other thing is we're going to incentivize STXRP versus FXRP trading. So if you deploy into those liquidity pools, which we're setting up, you'll be able to earn additional points on deploying into that pool. And what's interesting about that concept is you're going to be able to trade this locked up asset 24/7, 365. So if there is an exploit, I would expect that people will sell the STXRP first and ask questions later because they may not know if it's being insured, even though it'll be fully transparent with everything that you'll be exposed to once we launch. But people might speculate that maybe there's contagion effects or knock-on effects, and I would think that in the secondary market that would trade down. It would also allow people to get out at a discount, depending on how big that discount is, before the end of their lockup. So we're going to support that activity. Supporting STXRP as collateral, I think in Kinetic, I think that's a terrible idea because as we're building this to be safe and have minimizing the amount of exploits because of the use case we're trying to solve for, there is still a risk of loss. And using it as a collateral asset on a money market that's not completely segregated, like a Morpho model versus an Aave model, I think is very poor risk management. I think if that was used as collateral and there was a big exploit, you could take down the whole Flare ecosystem. You could just wipe out Kinetic uh,
you know,
with tons of bad data. So, I get everybody wants to be a degen, and I get the risk of exploit is essentially zero during this lockup phase. But come on, guys, kick in some mental help here.
yeah, look, insurance is like a massive problem that never been solved, and it took like we're going after something humongously big but very difficult. So help us solve that problem. I've heard that there is no need. We're gonna stand on the side of safety and risk management over speculation for the time being. So just help us get there. If we're successful, this opens the massive unlock for the next wave of DeFi. So Ethan is asking if XLM and HBAR someday. XLM for sure. So it's coming. We don't have a timeline yet, but we work very closely with Stellar. So that one is happening. Then Alex is asking, where do you get XRP? A lot of XRPs in exchanges, most of it. So we're working, obviously, we work closely with Ripple, but we're working with a lot of exchanges, wallets, some of the biggest holders that they're going to enable Firelight natively. Their interface are working really, really hard of this.
Can I jump in
Louis,
really quick?
yeah.
I think the question is why did we choose XRP? So the big reason
Oh,
we
what
chose
do you think is, yeah, so,
yeah, so XRP is one of the 3 or 4 most valuable by market cap assets in the market. It has a significant amount of secondary liquidity, um, and it has very little utility other than to hold it. And so that kind of met the 3 metrics. And this is what Jesus was talking about, zero cost of capital. XRP holders have the option to do nothing, earn nothing, or now earn something based on what Firelight will offer them. So I think versus someone like an Ethereum that can earn a staking yield, or if they're a little bit DeFi capable, can loop, LSTs and earn an even higher yield. XRP, you can't deploy into Aave and earn any yield, or use it to borrow stable coins and try to earn a yield. So that's a big reason. Also, we needed a big secondary liquidity because in the event of an exploit, the XRP needs to be sold to fill the claim. So we couldn't pick an asset that has limited liquidity if we want this to be robust. So hopefully that answers your question. The other side of this would, and then no one asked this, but and I'm happy, but that they didn't ask it, but I will say it. Um, I'm sure there's people in the XRP community being like, "Man, I wrote this thing up from 2 cents. We lived through all the lawsuits. Why would I want to deploy my XRP to earn 3 to 5% to ensure degens?" I would think of it very differently. If I would say that the protocols, you'll see the protocols that we're going to insure. You'll see the pools within the protocols we're going to insure. You're going to see the assets we're going to insure. My question to you is, if you could supply XRP on Aave or Morpho and earn 3 to 5%, would you do it? And our belief is a lot of people would say yes, because that's essentially the risk you're taking. Hopefully that clears up that subject.
Cool. So there is a question here on Anonymous about whether BTC, we're using BTC and XRP to insure DeFi assets. Are these truly uncorrelated, and how does that behave differently than ETH? Do you want to
Say
take
that.
that?
Sorry. Yeah. Say that
So
one more
we're
time.
using
Sorry.
BTC and XRP. Are those truly uncorrelated with DeFi, and how is that different than using ETH?
Well, one way it's different than using ETH is ETH has a staking yield. So when you think about cost of capital, if I want to use ETH, I need to beat the staking yield and then put a premium on top of that. With XRP, I need to beat zero. Now, that's not saying people would deploy 5 basis points because it's more than zero, but the returns to bring in scale, the cost to me is much lower than bringing in something like ETH that not only has a staking yield, but also through the invent of LSTs has the ability, if you are so inclined to take what I think is somewhat of an absurd amount of leverage, you can earn north of 10% on your ETH. So again, why would you want to use ETH to earn 3 to 5% when you can earn 3% just by staking it, or more than 5% by looping it? Hopefully that answers the question.
Um, yeah, and then there is another question, last one, saying that it does a ball have a cooling period. So one thing that we do, obviously, there is a claim that is being processed. We log funds related to that policy, and then to withdraw, there is just a few days, um, like in other protocols. Other than that, there is nothing.
If someone asks where's the yield coming from, the yield is coming from the premiums paid on the insurance contracts. So if we insure Morpho XYZ pool, the curator or Morpho will pay us a fee, and that will be given back to the stakers. So the yield is real. It's coming from what the protocols and the asset issuers are paying for insurance.
Cool. I think we need to wrap up. This has gone for the full hour. So this was awesome, guys. Super, super incredible questions. So thank you so much for joining. Follow Firelight on Twitter. We're posting a lot of content related to this. We'll be posting the recording on this webinar, and hopefully we'll see you in the next one. Thank you very much.
Thanks, everyone. Appreciate it.